If you have a 401k account and you're planning on using that money to retire one day, there are three very serious tax mistakes that people make all the time that ends up setting them back years on their retirement. The mistakes I'm about to show you are very serious, by the way. I'm not exaggerating, and this is not clickbait. If you have a 401k, you have to know these things. So, in this video, I'm going to walk you through each of the mistakes and give you the info that you need to avoid them. My name's Dave, a real licensed CPA. Let's take a look. Mistake number one is people sometimes take out all of the money all at once because they think it's tax-free, but it's not. When you take money out of a 401k, that money is taxable and can push you into a much higher tax bracket. Let's take a look at this example. Let's say that John and Sarah have been saving responsibly for 40 years. They've been doing the right thing, and they have 800 grand in their 401k, and they're ready to retire. They think their 401k is tax-free, so they take out the entire 800,000. Here's what happens with their taxes. Because they pulled out the entire 800 grand, that pushes them all the way into the 37% tax bracket because that entire 800k counts as taxable income in that year. The result is that they end up paying a little over $200,000 all in one shot. Now, before we go to mistake number two, to be clear, there are situations where taking a large withdrawal might make sense. Maybe someone has a short life expectancy, major medical expenses, or a specific plan for the money. And the mistake is not necessarily taking the money out, but the mistake is taking it out without understanding the tax hit first. Mistake number two is taking money out of your 401k when you change jobs and not rolling it over properly in time. Here's the rule that you have to know. When money is taken out of a 401k, you have 60 days to get it into another type of retirement account, usually another 401k or an IRA, before it becomes taxable income and you run into the same problem as in mistake number one. So here's how people get into trouble. When you leave your job and want to take your 401k with you, you're going to be given two options. Option one is called a direct rollover. What this means is that your old job's 401k will send the money directly to the new job's 401k or other retirement account. The money never actually ends up hitting your direct bank account because it goes right to the second one. Option two is called an indirect rollover. Essentially, your 401k sends you the money directly, and the moment that money comes out, that 60-day clock starts ticking. And what usually happens is someone will choose an indirect rollover, they start a new job, they start working hard to make a good impression, and then they forget to put the cash into the new 401k account. The 60 days ends up passing accidentally, and now they're looking at a huge tax bill. So all of this can be avoided entirely if you simply do a direct rollover. Now, mistake number three is another one of those that can cost you a whole lot, but is easily avoidable. Mistake number three is forgetting about state taxes and how they affect your retirement. A very common plan that a lot of people follow is they typically work in a higher tax state like New Jersey or New York, and then when they plan to retire, they go to a lower tax state. But a surprising amount of people forget that if they're still living in that high tax state and they start making withdrawals for something like moving expenses, for example, then they're typically still going to be subject to that state's taxes. So be sure to double check your residency before you start taking money out because it could save you thousands if you plan it correctly. Thanks so much for watching.